Last last week we have studied financial ratios usage part 1, and in this week we will study financial ratios usage part 2. Starting with this part 2 of financial ratio usage chapter, first of all we will start with activity ratio. What activity ratio is, how we can get the uh, details of effective quality of receivables, and how successful the firm is in collection of its activity it's performing. So starting activity ratio, what we do, we need to do collect first of all income statement balance sheet ratios, and from income statement balance sheet ratio we will get these things. Activity ratio, what is it all about? It indicates the quality of receivables and how successful the firm is in its collections. Activity ratio give you how much receivable you are getting from the company operations and how much net credit sales you are doing. So it basically give you effectiveness of operations of a company operating in an area. Here we are, as you know that in chapter part 1 financial ratios used part 1, took the balance sheet income statement of Pepsi Cola company on December 31st, 2019, and we are applying these formulas financial ratios on that. So activity ratio, what we do? First of all, we do find receivable turnover. How? Assume that all sales are credit sales. We need to get annual net credit sales figure from income statement. We need to get it shows that how much efficiently your total collection was in that period of your receivables and how much effectively you utilize the annual net credit sales of your products and services. Again, in activity ratio, for getting more detail of activity ratio, we go for average collection period. Finding out of that, again we will take income statement balance sheet, and we will find out that activity ratio of average collection period. Now to finding average collection period activity ratio, and why we are doing it, we are doing it to find out average number of days that receivables are outstanding. And when we call out average number of receivable outstanding date, we call it RT, receivable turnover in days. We need to find receivable turnover in that case. So average collection period is equal to days in year divided by receivables turnover. So for Pepsi Cola, December 31st, 2019, income statement balance sheet, you will get days in year, which we all know they are 361. And receivable turnover is that which we calculated in last slide. Last slide, if you see, receivable turnover was 5.61. We were dividing annual net credit sales of Pepsi Cola and divided by total receivables of Pepsi Cola, and we get 5.61. So here we will divide 365 by 5.61, which means average collection period of activity ratio calculation of the company effective performance was 65 days. So in 65 days means 300, in less than half of year even we can get average collection period, and we can calculate how much receivables we are getting, how much annual credit sales we are getting, and how much receivable turnover is there of we are utilizing that receivables amount of money in different turnovers of the company. So that's why we carried out activity ratios and applied that formula. So here the answer is 65 dividing 365 total days in the year divided receivable turnover in last slide, which we get 5.61, and this 5.61 was calculated by getting dividing that average net credit sales divided by total receivables, we get 5.61. So here we divide again for calculating RT, activity ratio and return turnover in days, 65 by 5.61, we get 65 days. So in average collection period is 65. So if we do go for activity ratio comparison and average collection, going ahead for finding out payable turnover in activity ratio, again we need to get income statement balance sheet ratio for that, and we indicate this. Why we find out payable turnover? We find out payable turnover to indicate that the promptness of payment to supplier by the firm is how much actively firm can pay out to the payable turnover to the suppliers, accounts payable to supplier. And for this we will divide annual net credit sales by accounts payable. Annual credit sales, annual credit purchases divided by accounts payable. Annual credit purchases are 15.51 dollars, and accounts payable were 94. By looking into income statement balance sheet ratios of Pepsi Cola, and we get 16.5 which shows us that payable turnover is 16.5. To find out payable turnover in days, again, why we are finding out? We are finding out because to calculate average number of days that payables are outstanding, days in year divided by payable turnover. For Pepsi Cola on December 31st, 2019, we divide days in year by 16.5 as we calculated in the last slide of the payable turnover. So we get 22.1 days. It means Pepsi Cola is ready to pay its accounts payable to the suppliers in 22.1. Now it's good or bad? Let's have a look at next slide. That's the next table where we will do comparative analysis of Pepsi with other industries. Now, looking at the table from 2017 to 2019, Pepsi Cola was on 43.5 in payable turnover. In 43 days they could pay. In then 2018 to 25 days they could pay to their accounts payable to their supplier. But in 2019 they have drastically improved to 22.1. Now, if you look at the industry, Pepsi was performing better than the industry. 48.5 days industry was in 2017, 51 days in 2018, and 46.7 in 2019. So it means Pepsi is performing on half of the time period in which they can pay their readiness. They are ready to pay to their suppliers, their accounts payable to supplier to in short span of time. So Pepsi Cola December 31st, 2019 has improved in this side of things. So if we go for this type of activity, we need to know if going ahead with this, we will find out activity ratios. Again, we have to find here inventory turnover. In previous slide, we were finding out average collection period, we were finding out payable turnover, we were finding out payment turnover days, we are finding out average collection period time period and how much days we can pay. So we were basically checking the firm's financial position here, right? To check whether firm is ready to pay how much in time they can collect money. They are collect they are doing sales and collect all receivables in 65 days, and how much in how many time period they can pay to their account payable to the supplier. That was 22 periods, very good than market. And the other industry like Coca-Cola, Nestle, Mariberi, uh, uh, Tops, Maza, Shezan, etc. Beverages company. Now, in inventory turnover, we'll see income statement divided by balance sheet ratio. You will get again, you have to find income statement balance sheet to get these figures of cost of goods sold, inventory. Activity ratio, it indicates the effectiveness of inventory management practice of the firm, that how effectively and efficiently your inventory available in your company is managed. So to get inventory turnover data, we have divided cost of goods sold. We will get from income statement where we call it CGS, cost of goods sold figure. How much cost of goods sold was in 2019 December till 2019 December for Pepsi Cola. We will get that figure and divide it by inventory. How much inventory that was available. So cost of goods sold was $1599. Inventory was 696. So we get 2.30. Let us have comparative analysis of it. Inventory turnover ratio. Now we will do 3 years comparative analysis of Pepsi Cola with other industry companies, other beverages company operating in Pakistan. In 2018 it was 2.64, in 2018 it got to 2.44, and 2019 got to 2.30. Industry was operating at 3.69, then 3.76 in 2018 and 3.45 in 2019. So for Pepsi Cola, December 31st, 2019, it has a poor inventory turnover ratio. So Pepsi is poorly managing its inventory as compared to the market. Like in a figure, you can see from the last 3 years, it are less than 3.69 was in 17 of the industry, and we was 2.64, 3.76 of 18, and we were 2.4. 3.45 from the industry at 2019, and we are at 2.30. So Pepsi is poorly managing its inventory, and they are not effectively managing inventory system, inventory turnover ratio. Now, trend analysis of inventory turnover ratio. If we plot it in a graph, like we plotted ratio value analysis ratio from 2017 to 19, it's reducing. Industry you can see it's from 3.5 going upward. and 2018, and then a bit down in 2019. But Pepsi is continuously going down. So if continuously going down, it means 10 days of inventory turnover ratio is negative, and Pepsi is going downward. It's barely managing their inventory, right? So that's why we are applying this financial ratio to find out details of Pepsi company performance in 2019, and then comparative analysis from 2017 to 18, its last 3 years performance as well as its financial performance with other companies. Moving ahead with activity ratios, then we will get again you have to look at income statement balance sheet for getting data of where you find total assets turnover, how much assets the company has and how they are operating. This total asset turnover ratio indicates that overall effectiveness of the firm in utilizing assets to generate sales. How effectively and efficiently assets of Pepsi company is utilizing to generate its sales. What we do, divide net sales, how much net sales we'll get it from income statement, and total assets we'll get from balance sheet. Net sales divided total assets, that was 211 were net sales of the Pepsi in 2019 December, and in 2019 December 2169 were total assets. So 1.02 was the total assets. Now let us have a comparative analysis of total assets turnover of Pepsi Cola with other industry and with its own self from 2017 to 19. 1.01 in 17, 1.03 in 19, and 1.02 in 2019. 1.13 of the industry in 2017 total assets turnover. Total asset turnover was 1.14 in 2018 and 1.17 in 2019. For PepsiCo December 31st, 2019, it has a weak total asset turnover ratio. Why this ratio is considered weak? It's considered weak as it's low from the day one from the market. Like here, if we see 0.12% we are low in 2017 Pepsi Cola. If here we see 0.11% we are low than the market industries operating. In here if we compare 0.15% we are low than the other beverages companies operating in Pakistan. So Pepsi has a weak total asset turnover. They are weakly, they are not they are not perfectly utilizing their all assets to generate sales, right? So their asset turnover ratio is weak. Very interesting, very important. Profitability ratios. Why we apply profitability ratios to get find out gross profit margin. Why profitability ratio is applied? Profitability ratio indicates that efficiency of operations and firm pricing policy. How efficiently the firm is operating and how efficiently the pricing policy is done. So find out the firm's operation details and firm pricing policy detail. Divide gross profit by net sales. Gross profit is in income statement given, and net sales is also income statement given. So here we only need income statement. Gross profit divided by net sales for Pepsi Cola in December 31, 2019 was 612 gross profit and net sales was 211, so 0.277. What this shows, from 2017 to 19 gross profit margin comparative of the Pepsi is done, and then with the industry is done. Pepsi was on 31.3% gross profit margin in 2017. In 2018 it has reduced to 28.7%. In 2019 it has reduced to 27.7%. If we compare industry, it was 27.6 in 2018 17. In 2018 it got improved to 30.8%. In and 2019 it was at 31.1%. It means Pepsi Cola Pakistan on December 31st, 2019 has a weak gross profit margin than other industries company beverages company. So gross profit margin is weak, it means company is not doing as much profit as the other beverages company or as overall industry beverages company of Coca-Cola, Mariberi, Shizan, Maza, Tops, Nestle are doing. So Pepsi gross profit margin ratio is weak. Let us plot it in a graph. If you plot it in an year-wise analysis and ratio value, we starting with Pepsi Cola is in blue graph line and industry is in red line. Pepsi Cola is continuously going down and down in profit margin, and industry is going up and up and up in industry margin. Pepsi Cola is weakly performing in gross profit margin ratio. Going ahead, net profit margin. Why we find net profit margin? It indicates the firm's profitability after taking account of all expenses and income taxes. All expenses are debited, all income tax are debited from your earning with the company. So we only need income statement here. We what we'll do, net profit margin equal to net profit after taxes. We will divide net profit after taxes from income statement by our net sales. For Pepsi Cola, December 31st, 2019, our net profit of tax $191 and our net sales were $22.11. So 0.041 was our net profit margin. Now, what does it? Let us have comparative analysis of net profit margin in with Pepsi from 2017 to 19 of the 3 years, and then comparing Pepsi with the industry from 2017 to 19. 9% was net profit margin in 2017, 4.9% 18, and 4.1% in 19. Industry was 7.6 and 8.1 and 8.2. So it means industry was improving, but Pepsi was going downward. So Pepsi for December 31, 2019 has poor net profit margin, right? Pepsi performance was low, their net profit margin was low. So Pepsi is not in as much profit as they are earning profit, but they are not earning profit as compared to market. There is 50-50% ratio difference between Pepsi Cola and other industry comparative